EMEA Business FM, where business comes to talk.
It's the morning drive. Banks are now raising their oil forecasts for 2026 as supply disruptions deepen. The market's grappling with what could be one of the biggest energy shocks in decades. Here with what it might mean for global markets, for Gulf producers and energy security is Matt Stanley. Matt is the head of market engagement for the EMEA and APAC at data and analytics provider Kpler. Matt, it's good to have you on the program.
Morning, Tim. Yeah, thanks for inviting.
You're very welcome. Thanks for coming on. Look, the route that normally carries about a fifth of the world's oil supply, the Strait of Hormuz, is effectively closed at the moment. Tankers are stuck, refineries are cutting runs, crude prices surging past the $100 a barrel mark. To begin with, Matt, can you put into context the significance of this, the disruption that we're seeing now in global oil markets compared with previous geopolitical shocks?
Yeah, look, this is a good question because this is what provides context. So if we're looking at the Strait of Hormuz just in terms of volume, around a third of the world's oil transits through the straits on a daily basis. Majority of that is crude oil. That's the Middle East Gulf countries that are locked into using that route. That is Iraq, Kuwait, Saudi Arabia, obviously with the Middle East Gulf hubs they have. ADNOC, of course, with the majority of the fields, Murban and Zakum, Das, etc., being locked in there. But it's not necessarily crude oil, Tim. We don't put crude oil in our cars. We put gasoline and diesel into them.
Sure.
And 20% of the world's jet fuel comes out of the Middle East Gulf through the Strait of Hormuz. 10% of the world's diesel. When you put that into context and what that means for previous disruptive events, obviously the biggest one that we can apply recently, and I feel like there have been far too many of them, to be honest, is obviously the Russian invasion of Ukraine. Europe used to get close to 50% of its diesel from Russia. When that was blacklisted, essentially, or sanctioned, the market had to find alternative supply. Middle East Gulf picked up a lot of market share. US Gulf Coast picked up a lot of market share. If you put that into the prism of where prices are, Russian conflict prices went up to about $139 a barrel on Brent. We touched 120 last week, 119.50. But where it's really being felt is into the end user is the diesel price. That is currently trading around $160 a barrel for delivery into Europe of diesel. If crude oil prices had gone up linear or increased linear with where diesel oil prices are, we would be at a record high on Brent. And I think that a lot of people are not factoring that in. It is a highly market disruptive event. But what's happening now, to be honest, the market is pricing in supply disruption, not the supply destruction. And this is a very important point of the market, how the market is reacting to the current conflict within the region.
It's an important distinction to make, I think, Matt. I mean, I was going to ask you for your feeling on how quickly the market starts to feel the impact when an artery, the Strait of Hormuz is the example at the moment, when that artery is blocked.
And this is another good point. What has happened is the reason that things have been tapered somewhat and from a market reaction point of view, and listen, I'm an old man. I've been in the oil market 25 years. I'm still waiting for my carriage clock to come this year at some point. But it's important to put things into context where they've been previously and what mitigants have been put in place already. So we look last week. The IEA announced the biggest ever release from the Strategic Petroleum Reserve, global. That's the US, the EU, Japan, around 400 million barrels. That buys around 45 days worth of supply, Tim. And the market seems to have essentially, I don't want to say bought that because that's a wrong adjective, but has sort of taken that it's eased any concerns in the immediate future that the market isn't going to have the oil it's needed. If things continue, then there'll have to be other mitigants that are put in place. China have got a lot of oil, close to 1.4 billion barrels roughly in their strategic reserve. So they're fairly well protected. The IEA release obviously protected a lot of other countries in the world. It's a regional problem, but it's felt globally. And that's really what the market is looking at right now.
There's also the domino effect, isn't there? Producers forced to shut in wells, effectively kind of turn off the taps, I guess. And you can't store the excess is the reason for that. The IEA estimates, I believe the figure is 8 million barrels per day in March in terms of the slump alone. And as you pointed out earlier, the shortage in terms of gasoline, jet fuel, but diesel as well.
Yes. Yeah. Look, these are the reference points. I think everyone's got to look at, because diesel is the world's biggest used industrial fuel, and we are guilty as an end user. We just turn up to the petrol station, fill our cars up. God forbid there's ever a shortage. I remember when I used to live in London, and there were petrol price strikes across the forecourt, and people panicked. That isn't the situation that the market is in. There are mitigants in place. For example, there is a pipeline from the east coast in Saudi Arabia that goes into the Red Sea that can take in a lot of crude oil, around 7 million barrels a day. There is also something that we have in the UAE, which is Murban, the main grade that the UAE produce, that can head into Fujairah on the Gulf of Oman to bypass the Strait of Hormuz. There are things in place to mitigate the situation, Tim. But of course, we think that even with those mitigants, around 3.5 to 4 million barrels a day is essentially locked into the Middle East Gulf.
And the other side of this as well is there's storage saturation potentially as well. If tankers can't leave the region, there are constraints on storage, simply put.
Absolutely. I mean, look, I was talking to the guys on Bloomberg early this morning. Sorry for dropping that in, but it's important because it's at what point do we kind of get to where the world sort of does reach, like you said, this saturation point? And it's a very important point, because simply right now, oil is, when we hit COVID, right? The only kind of bellwether I can look at this is the opposite side of what we've seen in oil markets. During COVID, I remember falling off my chair because oil was being given away because there simply wasn't enough places to put it. WTI went into a negative territory. That was demand destruction. Now we're on supply destruction. So it's the opposite way that we're looking at it. We're going to go from minus $20 a barrel for delivery in the US 6 years ago to maybe 150, who knows where, if these supply constraints keep on going. You're right. Eventually, supply has to be locked in. That is another issue in itself, because it's a lot more difficult to, not fill up a forecourt full of diesel or gasoline, as opposed to locking in a well that's been producing oil for 20, 30 years. So it's a unique situation we find ourselves in.
It's remarkable how COVID's become that kind of reference point as well. So alternative routes exist to move crude oil out of the Gulf. How much volume can realistically bypass the Straits of Hormuz?
Right. Okay, that's a good question, because what it says on the tin compared to what you can actually put in the tin is a different issue. 7 million barrels a day is the capacity, but when it gets to the port of Yanbu, which sits in the Red Sea in Saudi Arabia, how much can actually load? How much storage is available to take all that oil that's being pumped in from the east coast of Saudi to the west coast, and then can go on a ship without, logistically, operationally, before it becomes a problem? Maybe 4.5, 5 million barrels a day, something like that. Amir Nasser, who's the CEO of Saudi Aramco, was on an earnings call last week, said around that number. That's largely being endorsed by the market. If we're looking at Murban, that goes into Fujairah from the Murban fields in offshore Abu Dhabi, around 1.8 million barrels a day, something like that. So if you want to take a 7 million barrel a day number, then feel free.
In terms of banks raising oil forecasts that I mentioned earlier, we went from a predicted oil glut in January to talk of, I don't know, name a figure, $150 a barrel, whatever it will turn out to be at the moment. It's a hell of a market reaction at a very short space of time, isn't it?
Look, the job of a forecaster is to forecast often. That's when you get into the least amount of trouble. But you're right. Look, that was the narrative Q4. I remember being in Singapore for a big oil week there called APAC. And that was what was dominating the narrative, was the oil glut, and we're going to head down to $40 a barrel and wherever the sort of doom mongers were, that narrative quickly shifts. And that is how fragile oil markets are. That is what OPEC are there to do, essentially. And the UAE, the GCC core, making up the vast majority of that stable supply. That's how quick that things can change. So it's not a sort of finger in the air kind of job. The glut is still there, right? But it's just oil that people can't buy. It's sanctioned oil. That was one of the main mitigants last week. Obviously, we saw the waiver from the US government for India to buy sanctioned Russian oil. That's a temporary reprieve. Another one. Will we see the same in the EU for Russian energy? Look, I don't think there's enough time on the call today to talk about that, but that's certainly something that we think will be considered going forward.
That's a slightly different issue. Look, some banks have already lifted their 2026 oil price outlook. Do you expect, kind of crystal ball moment here, do you expect prices to stay elevated even, when we see the conflict stabilise?
I expect, look, there's two different ways to look at the market. You can look at it from the oil products point of view. So did I lose you there? Sorry.
No, we're with you. We got remotely.
You. Okay, sorry about that. You can look at it through the prism of oil products, gasoline and diesel, and then crude. The market is incredibly fickle, and prices in things incredibly quickly. Crude oil prices will be the first to react. And they could come down to the sort of $70 a barrel, around that, between 70 and 80. We held in a range for a large part of last year. If transit through the Strait of Hormuz comes back, it will be a 6 to 8 week lead time before things get back to normal. But it was way too early to talk about that. But for the end user, I think that refining margins will stay elevated, will stay high. And, that's the inflation story, what central banks do. We're hearing some central banks may consider some rate hikes going forward. The dynamic of markets has changed incredibly quickly over just the course of 2 weeks.
It has. We'll see what central banks do, whether they do delay rate hikes, of course. Which regions are most vulnerable to supply disruptions? Matt, Asia, Europe, elsewhere?
Yeah, look, Asia predominantly, right? Yes. That is, if you look at the IEA release of emergency of the SPR, they're going to start in Asia and Oceania. I think they're starting with around 100 million barrels. Then Europe at the end of March. So that there is a plan for how that oil will be rolled out. The issue that Europe has is that there has not been investment in the fossil fuel sector for a decade and more. So what's happened is a lot of the refineries, we read about them, have been closing down. So Europe largely now has become the sort of biggest, what we call the short in the world, the sort of place where people are selling finished grade goods because Europe simply can't manufacture them how they used to. The big winners of that will be the US, because they have a large refining system. Drill baby drill is still very much seems to be all people can talk about. I read an article in the FT at the weekend that a lot of the US producers are in for $100 billion windfall on the back of all this. I'm not sure we can use winners and losers yet, but Asia, and as a net importer of energy, they will be the first ones, to feel that, and then Europe close second.
Let me ask you about signals that we can take from the crisis. What signals should maybe businesses and investors watch to understand whether the crisis is, escalating or whether the crisis is easing?
Wow. Okay, that's a question indeed.
It's a tough one.
I think, well, that's okay. If it was easy, everyone would do it, wouldn't it? It's the targeted. It's how the attacks are targeted. If it's around infrastructure, which has shown somewhat fragile to a certain point, but a lot has obviously been mitigated there. I think that it's the shift in, if you want to call agenda of how attacks are looked at. We saw a lot on Fujairah that at the weekend that quickly came back. The airport this morning quickly came back. The UAE is incredibly resilient to this, and they will continue to be. They've done an amazing job. It's the wider region, right? Bahrain has unfortunately been going through a tough couple of weeks, as we all have. But it's targeted on the energy infrastructure. That's really what has shown the fragility in in the region to some degree, that's going to be a big. And I think, to be honest, government initiatives, government incentives, people want to keep the economy stable. Will we be in an environment where there will be financial incentives for people to get out there again if it's safe to do so? So government policy is going to be absolutely key to ensuring that economies can remain stable. And then from an attack point of view, I hate using that sentence, it's what is being targeted. Is it haphazard, or is it specific targets that the Iranians have in mind on energy infrastructure? That seems to be the way things are going. And then cohesion between the US and perhaps the UK or whoever the allies will be for a sort of overall agreement in how the Straits of Hormuz can reopen again.
In terms of international impact, what about this 10-40 rule that we keep hearing about? For every, it's an IMF thing, is it not? Where for every 10% increase in oil prices, you expect a 0.4% jump in kind of global headline inflation. That's kind of the idea. How does this hit, the average household in Paris, in Mumbai, in London, in New York? You can name your own city there,
Well, I think we've got a large presence in the US, and I think that's kind of probably the best case study to use. Right. Is we've got some friends who are in Houston, some colleagues, and petrol prices went up 20% last week. That's not conducive to a happy electorate, and I think that's going to be a story that's certainly going to raise its head. But like I said, we are down from the highs of last week. The issue themselves are very much still front and center, and we're in the third week of the conflict, but prices are down $20 a barrel on Brent. They are down on gas oil. They're down on gasoline. Diesel is gas oil. Retailers are very, very quick to adjust prices to the end user. We will certainly see that, whether that's a cup of coffee because dry cargo can't move as fluidly as it used to, or a barrel of gasoline to put in your car. As soon as a retailer is involved and is susceptible to price hikes, the end user will feel it straight away. Regionally, it depends where you sit, and if the governments subsidise fuel prices. In the UAE, we see, and vast majority of the GCC core, we see governments, the ones who value what end user products should be at the petrol station. But Europe, it's a free, deregulated market, so that will be an immediate sort of price hike, if not already.
Rising oil prices have a number of effects: gas, petrol, diesel, jet fuel, etc. Fuel for heating, LNG. But there's also an issue, is there not, in terms of fertilizers, because the Gulf produces nearly half the world's urea, and if that supply stays trapped, it's a lot more than an energy crisis in March or April. It's the potential effects on food prices later in the year. That's a very real potential situation.
Yeah, and look, I said this to someone the other day. And when did you ever thought, Tim, that you would be there considering the price of urea 3 weeks ago when you are now? And it's also, I put something out on my commentary on Friday, was around the price of helium. Now, if you'd have asked me a month ago what the price of helium was, I would have said you needed to be sectioned, because it was never something that we considered was an end user problem. It's everything, Tim, everything that exists. I would say, however, that what the UAE have done which is incredibly important, which I don't think gets enough airtime, is Etihad Rail. Right, Etihad Rail is key. Yeah, that is the main mitigant for dry cargo, for containers, for sugar, wheat, things that we need. Eid is coming up. That's the biggest sort of seasonal spike that we see in wheat prices, with Eid al-Fitr is coming up at the end of the week. And Etihad Rail is able to absorb quite a lot of that. I don't know to what regard. I'm not an expert there, but I'd be really keen to hear from them. But you're right. We don't just manufacture crude oil and drive around in Rolls Royces that we produce from our refineries. It's the whole supply chain, everything around sulfur, pet coke. Everything is around fossil fuels, really, within the region, and no one is immune to the price rises against those products.
Yeah, we're seeing stories this morning of how Etihad Rail has stepped in terms of transporting cargo around the UAE. Of course, you're quite right to bring that up, and it's had a major impact. Final thoughts, Matt. I mean, I'm interested in your thoughts on the potential for a reinvigorated push, if you like, for interest in renewables as a consequence of the situation we're in. I mean, solar, wind. In terms of the confidence in pricing and supply that renewables offer.
Look, this is where I'm a bit of a dinosaur when it comes to this, Tim, is that for me, the most important policy when it comes to any government is energy security. And it doesn't matter if that comes in the form of coal or gas or diesel. If the population of any country that a government is ensuring has energy security, it doesn't matter how you get it. The unfortunate situation renewables has itself in is that it is expensive and the infrastructure simply isn't there yet. If you look at, say, instead of ships using fuel oil and using LNG because it's better for the environment, it's just the infrastructure just simply isn't there. The investment isn't there. The price per ton of LNG to go on a ship is a lot more expensive than fuel oil. And it's the same whether it's renewables from wind power or solar, or the UAE again have done a great job in terms of the solar park, etc. And then we've got the new power station outside Jebel Ali that runs off gas. So it's very much dependent on policy of the country, energy security around the country. But it's I don't think Greta Thunberg and the renewable argument will surface anytime soon.
So many questions, so many scenarios, so many variables. Matt, I think Mira's too new a company to have great stock of carriage clocks. That's kind of a 25-year thing, but I'll see what I can do. Really appreciate you coming on. Matt Stanley, Head of Market Engagement for EMEA and APAC at data and analytics provider Kpler. Appreciate it. Thank you.
Thanks, Tim.
This is Mirror Business FM. This morning, coming up in not that long, actually, in a few minutes' time, we're going to be talking to Faisal Al-Muttari, who is, and I quote, the Chief Chili Officer at House of Habanero. The story of a business launching at, some would argue, exactly the wrong time, very recently, just as we see tensions escalate across the region. But Faisal's going to be here soon. Don't forget, you can stay updated with our news on X, former Twitter, our website, mirrorbusiness.fm, WhatsApp's Mirror Business FM channel, and you can search us out, get your podcasts wherever you get them from. Just look for Mirror Business FM. Really as simple as that.